All right, welcome back to On the Tape Podcast. I am Dan Nathan. I'm joined, as always, by Kaitlin Malin, COO of iConnections. Kaitlin, we have two very special guests today. We have Jan van Eck, CEO of VanEck, the namesake there, and Matthew Sigel, head of digital assets research at VanEck. Welcome to the pod.
Great to be here.
Well, listen, this is one that, Kaitlin, we thought would be really fun when we think about who your audience is, how our collective audience is from On the Tape listeners. Jan, your firm is at the forefront of one of the biggest investing trends, I would say, in my career over the last 25 years in markets, and the shift that your company, which had been around long before I had been trading ETFs, in the asset management space. But when I think about my career as an investor, as a trader, it really has been defined by the innovations in around, let's call it single stock investing, and that's been my focus. But ETFs has been something that, again, some folks have adopted and they use every day in their, investing process to express views, to hedge, to diversify, a whole host of things. What was it to you back in the mid-2000s when you said, I think this is going to really be a game changer for VanEck, pushing into the first one, GDX, which was one that caught the investment world by storm, because it was a really hard way to invest, I think, in gold-related things other than buying the physical, participating in the futures markets, maybe buying miners and the like. How was it that you arrived at that decision? How important was it for the company back in 2006?
Yeah, it was a little bit of an easy call for me, and I kind of felt late when we did it in 2006. All investors love tax deferral. So if you could give them tax deferral, which ETFs offer. But you touched on indirectly the second big advantage, which is liquidity. Gold shares are very liquid in bull markets, and they're very illiquid in bear markets. And you certainly don't want to be trading individual gold shares in a bear market, mid caps and things like that. And GDX, one of the brilliant things about it is it always is more liquid than all of the underlying shares. So it became the benchmark, if you will, for that part of the market, gold mining shares.
Yeah, and we're going to hit on a lot of stuff in the commodity complex and the like, and we obviously are going to spend some time, Matthew, on digital assets. It seems like this is something that is really might be as defining for VanEck, your push into spot Bitcoin ETFs and what you see across other digital assets in the not so distant future. And it's something that I know, Kaitlin, your users at iConnections are really focused on. Guy and I have been really fortunate to be at a bunch of your events over the last few years or so. You guys have had this big focus on digital assets because your customers want to have that focus.
Exactly. No, it's, for those of you who are familiar on listening to Global Alts Miami, it's a huge event. We host over 15,000 meetings each year in January. And one of the fascinating trends that I've seen is the growth in interest in digital assets really broadly. And of course, we'll get into this too, but digital assets means a lot of different things, a lot of different strategies. We're dealing with a very broad audience, so that we look at it across just the broad bucket that it is. But, 2022, 2023, 2024, the percentage of meetings that we've seen, it's ticked up slightly. Of course, in 2022, it was huge. It was shocking to us in terms of the small number of funds that attended. I think it was less than 20, maybe 17. But in terms of total number of meetings, it comprised literally, I'm looking at our numbers here, 10% of all meetings that took place. So huge, right? And then in, 2023, it was about 7%, and then 2024, 4%. So generally speaking, it's hovered, it's grown, the overall event has grown as well. But what do you have? I'm curious as well, just to hear, LP appetite and what we've seen as the space has grown, as ETFs have become more prominent in the space as well, and how LPs are grappling with this as an asset class overall.
The early allocators to digital assets on the institutional side were largely high net worth and family office, to some degree pension funds, but really putting it in that venture bucket, which allowed them to market infrequently and not return capital to shareholders or to their LPs. With the emergence of these Bitcoin spot ETFs, we've definitely seen the number of buyers proliferate, reaching into the RIAs, but also broadening in the pension fund world. We just saw a few days ago, the Wisconsin State Pension Fund added Bitcoin to their reserves. there's now a number of government entities outside the U.S. that are mining Bitcoin for their own reserves. We even saw a Bitcoin miner, a publicly traded Bitcoin miner, buy the ETF. So the cost savings, the security, the liquidity is widening the opportunity set. And there's $30 trillion in these RIA assets. About a quarter of those are managed by the independent, who have been faster to embrace the ETF. But now we're starting to see with these 13F filings come out that even the bank and broker-owned wirehouses have begun to dip their feet in the water. And as those entities put out, we think, more robust macro models that are maybe variations on that 60-40, maybe a 60-39-1, that the more consistent flows will come in from that institutional side.
Yeah, and Jan, you mentioned that back in 2006, it was kind of an easy call, right, to go into GDX. How do you think about this as you were weighing this? And I know that you guys were one of the earliest, financial companies to put in an application for a spot Bitcoin ETF, possibly going back as far as 2017. Is that correct?
Yep.
So this is something you guys have been giving a lot of thought to for a while. Did it seem as easy as some of the calls that you had made in prior instances to add, different asset classes to the ETF portfolio that you have?
Yeah, so just to take a step back, VanEck's investment philosophy is what I call a macro philosophy, which is basically don't just look at the financial markets inside the Bloomberg. Take a look at the big world. Look at political trends, especially from an international perspective, like the rise of China, and economic and political trends, and try to say, okay, are there opportunities in my portfolio or are there risks? And because of the course of my career, at least, there have been the emergence of asset classes, like emerging markets wasn't an asset class for a while, and then it became one, and maybe it'll disappear. So we tend to ask those questions of our clients. So you always have to be sort of looking at the world and saying, okay, is this a fad? Is it noise, or is there signal? Is this going to be a trend? So in 2017, had known about digital assets, did the deep dive, listened to the podcasts, right? Read the white papers, 100% of my time almost on that, and said, listen, okay, a large part of our assets are in gold. Is Bitcoin going to disrupt the core of our business? Like, that would not be good. And so said, well, yeah, I think it's accompanying it, like silver accompanies gold or platinum. So yes, we should position ourselves, and got bullish then.
So GDX is about 14 billion, correct? Assets under management. When you think about it, the gold market is 14 trillion, if you will, right? So when you guys think about that, Matthew, like, what do you think the opportunity is with spot Bitcoin ETFs? Because again, I think Bitcoin is 1.4 trillion, market cap right now. And we know that there's tons of instruments that are being traded in and around it, whether they be listed, over the counter, futures, so tons of options. So the notional exposure is much bigger, I think, right now. Give us a sense of like what you guys think the opportunity is here, because Jan just said, again, you spent a lot of time 5 years ago or so digging deep in this sort of thing. It seems like you wouldn't have done that unless you thought that this could be as big as, let's say, a GDX product.
Yeah. And well, even if it wasn't that big, we don't want to be beat at our own game.
Correct.
So if golden store of assets investing is our own game, however big it is, we don't want to be beat at it. In 2017, so since 2017, it's up 20 times. And I did look at it just sort of like, listen, it's going to be half of gold's market share. It's still got, 5X or 10X to run. So that's kind of our overall perspective. But so the way we think about, what we're getting a lot of questions about is, how do I allocate to Bitcoin? How do I know when to buy it? So people, like a financial advisor that a year ago wouldn't even talk to us about Bitcoin because they had that kind of prior Larry Fink view of it's illegal and all that kind of stuff. How do I think about allocating? Okay, let's assume it's a legitimate asset. And so we break that out into two components. First of all, the macro view, sort of Fed interest rate cycle, that kind of stuff. And then also, hey, it's just a network. It's a network of transfer of value. How's that network doing, right? If no one's using the network, it's going to go to zero. So I want to turn it over to Matt a little bit just to talk about the health of the network and how we look at that, because that's really a little bit of the nitty gritty for people. So we try to simplify it.
Sure. Yeah. So on the size of the opportunity, we've generated pretty high conviction that Bitcoin may protect against government devaluing your money through overprinting. And while that's somewhat relevant for Americans and kind of developed market consumers, it's particularly relevant for those who are living in high inflation economies, emerging markets, frontier markets. And that's where the real utility is for the network. The speculative part, the Bitcoin as a collectible, that is what developed markets investors are now trying to access through the use of that ETF. But we see it for those emerging market consumers. It's a pure anti-dollar bet. The one correlation that Bitcoin has had consistently is a negative correlation with the US dollar. And given the volatility, you can get with a 1% allocation to Bitcoin what it might have taken 5 or 10% allocation to an emerging market strategy, which maybe now contains 25% exposure to China, which is questionable. So Bitcoin is kind of that pure EM frontier asset class. And that's where it's being most used. So I come from TradFi, where we follow the quarterly earnings schedule, and we're looking for kind of incremental changes in the conference calls of companies across a number of quarters and years. With these open source blockchains, they are amazingly transparent, and you can observe the real-time P&L of these blockchain networks every day. So if I were to describe, what's the state of the earnings for open source blockchains like Bitcoin, it's been a beat and raise all year long. We've printed all-time highs in daily transactions, in daily fees, the number of Bitcoin addresses, the Bitcoin miner revenues, the percentage of coins which haven't been moved in a year. And that's kind of the hallmark of this asset class, the HODL that's on my hat and our ticker, hold on for dear life, or just in TradFi terms, buy and hold. Total market cap of crypto equities made an all-time high this year. The number of countries mining Bitcoin, I could go on. So the fundamental state of Bitcoin blockchain has been very strong, and it's actually taken quite a bit of market share versus other competing blockchains in the fee market. What are users actually paying to make these transactions? And if you're a supply sider like me, then you don't wonder what Bitcoin's intrinsic value is. You just observe the participants who are paying real money to make transactions and say, okay, they must be getting some utility. So our price target is half the market cap of gold, which equates to about $325,000 per Bitcoin.
Mm-hmm.
Why don't we dive in a little bit deeper into the fees side of it? This is not the world I live in on a day-to-day basis, but I'm just, you hear stories of fees being incredibly high and getting investors who are maybe just passive observers new to the asset class. How do they wrap their heads around the fees and they think about starting to invest in this in a bigger way?
Well, I'm going to start and then I'll pass it over to Matt. I think what confuses people is there's two ways that it's hardware runners. I like to use a very simple term, right? Bitcoin is a network that's run on software like any bank network. The people that provide the hardware services to the network can get paid in new Bitcoin, or they can they can get paid transaction fees for people who want to use the network. Over time, it will move from the new Bitcoin to the transaction fees because they'll run out of Bitcoin, right, in 100 years, probably past our lifetimes. So that's that dynamic that's going on, and we just know that the halvening just happened, which is the amount of new Bitcoin coming. So those are the two types of components. And I look at it like an ecosystem, right? Is there a balance? Like, can the network was it sort of constructed in a dynamic enough way for allowing the rewards in terms of new Bitcoin to go down over time and transaction fees to fluctuate? One could have said a couple of years ago, maybe no one will ever pay transaction fees. They just want to get paid new Bitcoin. But that of course, wasn't the case. So
and
add to that.
Recent innovations on the Bitcoin blockchain allow it to now compete a little bit more with the more programmable chains like Ethereum. So you can now mint NFTs on Bitcoin. You can mint fungible tokens that settle to the main Bitcoin blockchain. So that ratio that Jan was referring to, transaction fees or new Bitcoin rewards, the transaction fees have nearly quintupled as a ratio of total fees. So there's just more fundamental usage of the Bitcoin blockchain.
And again, you laid out, I guess, the case of why so many folks, both institutional and retail, are focused on this asset class. And obviously, there's a whole host of tailwinds that we've experienced this year, which is, given the price performance. But there's also a bunch of headwinds from the regulatory front. And so how do you, I'm sure, I know that you guys work very closely with regulators on all your products. Can you give us a sense of what it's been like working with regulators on this one? Because it seems like we're at the early days here. There's been lots of fits and starts. It seems like at times it's a very bipartisan sort of issue when you think about the folks that are, hopefully thinking about this and writing smart legislation and letting America be a place where innovation like this can grow and not export it overseas, that sort of thing. How are you guys thinking about, let's say, the next couple of years from a regulatory standpoint? And, Matthew just mentioned, Ethereum and the like. I mean, are we going to see ETFs on things ex Bitcoin in the near future?
Well, let me answer it again from my own perspective. Historically, why in 1968, when VanEck started the first gold mutual fund, did it not invest in gold bullion, invested in gold shares? And the answer is it was illegal to invest in gold bullion in 1968. And so the fact that the Bitcoin ETFs, that's the genie out of the bottle in a way. You can't unpack that, right? So I do feel it was a big symbolic step forward for the industry. Of course, the SEC only did it kicking and screaming.
Yeah.
So that's where we're at, and I do think that's very important. But yes, on every other front, the regulator has not tried to provide clarity for what is a little bit of a hybrid asset, like whether it's a security or not is a borderline case, I would say, from a legal perspective. But anyway, they haven't tried to provide clarity. They've just tried to slap the hand of anyone that got close. And so that's delayed implementation in the United States. And to me, the biggest real use of this blockchain software is going to be stablecoin payments. Matt points out that the volume of stablecoins is approaching that of the Visa network now. So what if it's 3x Visa, which is not a stretch, right? That's possible. It doesn't have a large asset base, but it has a lot of transaction volume. Well, that's starting to become the genie out of the bottle. And if that is all located in Dubai, Singapore, and continental Europe, like our payment system will just be different than that of the rest of the world, and in some ways less advanced, right? Because stable coins can operate 24/7 over weekends and all that other kind of stuff. So, that's the cost.
I think that while the administrative state may, remain somewhat hostile, there are some encouraging signs on Capitol Hill that legislators from both parties are recognizing that the asset class has popular support and that stablecoins may actually cement the role of the U.S. dollar as the reserve asset for the next 50 years. If we can get stablecoin legislation done, then there's a good chance of a multi-trillion-dollar stablecoin term deposit market that becomes very similar to the Eurodollar market. The stablecoins are currently collectively the 16th largest holder of U.S. Treasuries. That could be number one if this industry is allowed to flourish. And again, there are some signs on Capitol Hill that both sides are agreeing on that. And I would add that if that happens and stablecoins continue to take market share versus Web 2 payments networks, open source databases with tokens like Ethereum and Solana will benefit. So we are trying to capture that upside.
I put slightly differently, just to sort of emphasize that point. In a way, you could flip the tables out and say that the clock is ticking on the regulators, right? Because if they don't get their act together on stable coins and the trends continue, and why would they stop? They'll be too big to, they can't put that genie back into the bottle, even if they try in the United States. Right. So that's kind of interesting.
Well, it's interesting. Kaitlin, you guys hold events all over the world, right? Singapore, and, in the Middle East and the like. And are you seeing some of the same kind of interest in digital assets when you were out there holding those sorts of events as you do here in New York and Miami and the like? Because again, I feel like after that kind of crackdown after the ICO thing in 17 and 18, there was mining issues all over the place. Then we've had, the issues with some of the exchanges leading into 2022. I don't have to remind you guys of all that sort of stuff. It seems like a lot of stuff went away from North America for the most part, right? And so I'm curious, are you guys seeing that level of interest as you guys travel the globe and hold these events? And, a lot of these investors, a lot of these allocators, a lot of these fund managers who are here in New York or Miami, they're also showing up in Dubai. They're also showing up in Singapore. And I'm wondering, is it consistent interest over there as it is over here?
Yeah, I can speak to the interest, and I'd be curious to hear as well in terms of just the appetite and learning about the asset class. But again, we think in terms of punching average. So if a certain number of fund strategy represents a certain percentage of the total attendees, what percentage of meetings are they taking? We host an event in Singapore each year. Last year, there was about 10% of the funds there representing the digital assets asset class, and they made up 9% of meetings. So slightly under the punching average, but overall pretty close.
When was that in the year?
That was fall of 2023.
Okay.
So, and yeah, you can probably connect the dots better than I can, right?
The beginning of the year was ice cold, and then by the end of the year, things were rocking.
Exactly. And then the year prior, I think there was a lot more hesitancy. If I looked at Singapore in 2022 relative to 2023, there was just that much more comfort globally with the asset class from an LP appetite. So we're definitely seeing more interest. I do think it's interesting that a lot of the direction, the news on ETFs was huge for our world in terms of just comfort and getting on board with understanding the asset class, where it did feel like there was a shift from, okay, this is just something I want to learn about and I need to be aware of, to now I can actually start to see a reasonable path where I can have this in my portfolio. But I'm curious too, because right now, we just spoke about the U.S. legislation and that driving the way that you can gain access to it. What does that look like more globally?
I can give you one data point that supports the brain drain story that is out there around American people in crypto moving overseas. We track very carefully the number of developers that are working on these open source databases. And because they all use GitHub to collaborate on their code, you can actually see where they're located by country and continent. Developers from the USA 5 years ago, around the time of the ICO boom, were some 60% plus of open source developers. And now that number is closer to 30%. So it's been a huge market share gain in Latin America, EMEA, Dubai, and Asia at the expense of the U.S., and we have not seen that trend abate.
Jan, how do you think about differentiation? We can broaden this out a little bit, right? Because again, there's been, there's a bunch of spot Bitcoin ETFs that had applications, many far later than what you guys have been on this train. So a lot of Johnny-come-latelys. I think a lot of folks not doing the sort of rigorous work that you guys are doing recognize the same opportunity that you see. So how do you think about, and we can broaden it out beyond, let's say, Bitcoin, how do you think about differentiating some of your products where that there's a lot of competition, right? Thematic investing is important, but then there's a huge push towards passive investing, right? And you want to gain market share in your space. You've been doing this for years and years, for decades right now. How do you think about that?
Yeah, I break down investor interest into different categories. So the individual investors, I think, flooded towards these ETFs, and we got a good share of that. So happy about that. I think what's the immediate open question in my mind for Q2 is financial advisors and RIAs, and to what extent they, allocate to Bitcoin. None of the biggest broker dealers, to my knowledge, have yet approved a Bitcoin ETF in terms of proactive advice. They can take orders, but they can't give proactive advice. Another big trend that's happening, so the problem is the volatility of the asset class, right? People always want to buy at the top, and at the bottom, it's going to go to zero, and it's impossible to handle. This couples with another major trend in the financial advice industry in the U.S., which is the fact that a lot of advisors don't themselves want to do the allocation or the fund picking. They really want to partner with an investment expert. And we do this too at VanEck, where we're allocating. And so my bet is that a lot of the financial advisor marketplace will be buying Bitcoin through allocation strategies. I think BlackRock has an allocation strategy. We have one. And so the advisors will kind of defer. And so we're going to see, I know we just got approved and upgraded at one of the biggest public kind of allocation tech platforms. Not ready to announce it yet, but over 100 billion. So they're going to be buying our ETF, but indirectly through an allocation strategy.
I think we differentiate on three things. Skin in the game, which is Jan and the firm put $70 million of our own money into this fund, and you'll see that across many of our ETFs and strategies where if something is underperforming and you need to pick up the phone and talk to someone who is feeling the pain, like we're going to know why it is. We're going to be on top of these investments as much as anyone.
Is that a very unique sort of thing? I mean, I have to assume because I don't think the folks at iShares are plowing their own partner cash in there or anything like that.
I mean, I was told before I joined this firm, we cook some very good food over here and then we stuff ourselves full of it. Right. Are you prepared for that? So the first is skin in the game. The second is deep research. We have models and price targets that are public on a lot of digital assets and a lot of our other more traditional securities. And we want to learn alongside of our customers and make that transparent. And if you follow us on social media, you'll see it's all out there. And the third is...
Just to elaborate on that, for the allocation strategy that we run that allocates to Bitcoin, we were actually taking profits, I think, in March or April. So we have a lot of different asset classes. We're not always bullish everything. We have my investment outlooks and firms' investment outlooks on our website, so you can look back or you can look at CNBC clips.
Are you gonna? That sounds like a great tagline. Not always bullish on everything. It's kind of the anti-Merrill Lynch thing, John.
Well, I mean, our view is like the world economy is going through different cycles.
Yeah.
And listen, we are very. My worldview is to be skeptical about any kind of conviction that we have.
Sure.
So we don't have a prediction on everything in our house view. We never kind of have a house view on the dollar, for example. But when we do think something is overdone, like growth was way overdone at the end of 2021, and I used to bring out railroad charts to show how every disruptive technology has a big crash. So that's our view. I mean, there is this happening cycle of Bitcoin, so it is likely we will be bearish in 2026, right? Because every 4 years, Bitcoin has a dirt nap.
I just remember the third. It's the ticker. Tickers can be differentiators, and
that's good.
We've got
That's marketing.
the most memeable.
Yeah, definitely. Jan, you're known for bullish views. You're known for being vocal. I'm curious, just taking a step back away from Bitcoin and just more macro level. I think you're expecting a fiscal reckoning in 2025. What big calls can you share with us today?
Yeah, I think there's two things that happened in the first quarter of this year that are notable from a longer term perspective. One is that global growth returned. So we use this measure called Purchasing Manager Index, and that went over 50 in Q1, which is the first time in 2 years. And it's also trending pretty aggressively. So that's great for commodities as a tactical trade. And that's just sort of once the world economy gets over, and I think they're getting over the China property. This is Jan's outlier theory. I would tell you 9 out of 10 Chinese economists will disagree with me, but I think they're kind of moving through the property bubble that they had there. And there's a lot of other growth drivers like India and things like that. So it's more diversified growth. So that is good for that asset class, commodities. The second thing is I think the biggest risk in the market by far is the U.S. fiscal government deficit. We've never been spending this much money at such low unemployment levels. I think we will look back at 2023 and 24 and say, what the hell were we doing? Like future generations. Now, I think the markets might at some point be concerned about that spending, which would be reflected in higher 10-year interest rates. I think it's a 20% chance, but there's a lot of things happening in 2025. You've got the Trump taxes. You've got the fact that Social Security is going to go bankrupt in 2033 or 34. So it's either, if we only solve problems the year after a presidential election, it's either next year or 2029. 2029 is really late to fix a retirement system that's about to go bust 4 years later. And then the third indicia to me is that our debt payments, our interest payments on our debt is past defense spending. And that during the Clinton administration was like a political kind of, tripwire, I'll call it. Listen, 80% of the time, like you could just say, well, we're going to fake our way through it, kick the can, and the Fed will just buy our debt like Japan did for 20 years. But there's a risk. That happens. And that's why I've been pounding the table on gold and Bitcoin. If you're ever going to own it, this is the time, because the market we know there's this embedded risk. It may not occur, but if it does, it's not going to give you a lot of warning. Mm-hmm. You're going to be on the beach in August and suddenly the market's going to freak out, or you're going to be focused on something else with your kids or whatnot. And then suddenly, markets can disconnect so quickly that you think you can get positioned, and I don't think you can.
Yeah, but what you're talking about, and again, these are sorts of things that could really rival a 2008 sort of, financial crisis, and really because the debt issue it's actually been, multiplied since 2008, if you think about it, right? And so, it's something that everybody has an interest in kicking the can down our road, except our kids. You know what I mean? If you think about it, no one wants to deal with these, either party wants to deal with these issues. So, to me, I think that's a huge problem. But let's go back really quickly. And
the other thing is, but we're so used to the problem being with the consumer, I'll call it unemployment, or corporate America, call it mortgage debt or the banking system or something, and the government coming in to save one of those two sectors. Mm-hmm. Now both of those sectors are in awesome shape. The consumer's happy, for the most part, right? Everything could be better, but corporations are in fantastic shape, right? Now the problem may be caused by the government. Right. So that would be, everyone's not looking in that direction. It's kind of like our housing problem. Right. Housing hadn't been a problem for decades and decades, and then suddenly it was. Right. So I think we just want it's weird because we all talk about it, but I think we could still be blindsided by this.
Yeah. How do you think, so you just said gold and Bitcoin, obviously as a hedge or just a means of diversification against that sort of calamity. But when you think about current allocations towards both, no matter who you're looking at, we're talking low single digits, right? So think about the move that gold has had 15% this year or so. It's basically gained the market cap of Bitcoin, right? So if you're low single digits, I don't know anybody other than your hodlers, who are all in, on crypto. Most 60-40 portfolios with 2 or 3% of gold and Bitcoin, it's really not going to do that much for them if we have a 2008, 2009 situation, or going back to the bear market of 2000 to the lows in 2002. Is that fair? You know what I mean? Like, that's one of the reasons why.
Yeah. But there's another thing you need to do too, right? If 10-year interest rates go up, any bonds with longer maturities are going to do a dirt nap like they did in 2022. Right. Therefore, also shorten the duration of your debt. Yep. And stop calling U.S. government debt risk-free, because that could be the locus.
Well, listen, on a 3-month basis, I can get 5.4%. That sounds like a great risk-free
exactly.
rate.
Yeah, exactly. I mean? So why bother? Yeah. Why bother?
Well, I guess the other thing I would say, is like, to me, in my 25-year career as an investor / trader, those vehicles like GDX or they've been great trading devices. Like, this is how hedge funds add alpha, right? Like, they look at those and they anticipate what folks might go to, right, to kind of get that sort of diversification or that hedge. Does that make some sense? And I'm just curious, like, what percentage of the volume do you see in a macro period like we are in right now, where people are focused on rates? They're focused on what the Fed's going to do next. They're focused on fiscal deficit and spending and the like. Like, is it like trading or is it investing that really drives a lot of the flows?
I think it's investing.
Yeah.
Like, if you look at ETF flows, a lot of it's from these portfolio models. And a lot of people use their own ETFs, like BlackRock uses a lot of iShares ETFs for their own models, which is fair enough. We do the same thing. So I do think allocators, and you had a good point earlier today, Matt, which went to the sort of correlation benefits of Bitcoin in the portfolio. But I do think that they will, now they're not going to go, to kind of push back on those two things. Like, they're not going to go to 30% Bitcoin or gold, right? Number one. And number two is the risk that, let's say they had a 10% position and it went to 30%, God forbid, they'll take profits. They won't let it run. So I'm not saying I love those models or the methodology behind them, but why don't you also maybe talk about why models would use Bitcoin?
Yeah. So the work that we've done, Bitcoin improves Sharpe ratio, improves total return and volatility anywhere up to about a 5% allocation. That's as comfortable as we've gone in kind of recommending. I have seen some theoretical work out of Citigroup that argued for up to 25% in crypto.
Wow.
But I think it really comes down to the goals and objectives of the end investor, right? But from my perspective, I have 0% weight to long dated government debt, right? So I'm very barbelled. I have like 60% equities, 25% crypto. The rest is cash, T-bills, waiting for an opportunity. And I think that the amount of debt which is concentrated at the government level, specifically the G7 level, the rest of the world is looking at that. They're objecting to how we are deficit spending, what the things that we're deficit spending are. And on the margin, they're moving away from government securities and towards these hard assets, gold and Bitcoin. So I'm just following those flows.
I'm curious, you've been pounding the table. You're still worried that it's going to be a surprise to everyone. What tagline, what storyline has resonated with people where it actually gets them to pay attention and think twice about how they're allocating?
Nothing resonates like the price,
of course.
But for me, it's the countries around the world that are doing this at the government level. So El Salvador got press for being the first to declare Bitcoin legal tender and mine
a real country
and mine Bitcoin. But there's now 7 countries around the world that are doing this at the government level, and they are all relatively poor countries with a lot of energy. And it's energy that they wouldn't be able to monetize without Bitcoin, because a lot of times it's stranded or it's in socially unfavorable sources. And because you can set up a Bitcoin mine with less CapEx than it takes to build a high voltage transmission cable, it makes a very flexible way of getting access to hard currency. And there's always like 5% of the world that's in default to the IMF at any given point. Some percentage of those countries are going to look at Bitcoin as a negotiating tool. And a way to gain access to hard currency. And that's how I think it ends up like this spreading disease in a good way.
No, Kaitlin, I think that's a great question. I don't think anything has triggered investor concerns. When I give this pitch and I do it a little bit more fervent, a little bit longer, at the end of the day, half the people in the room are like, no, it's not going to happen. We're going to kick the can, no problem. But that to me is the great investment opportunity because it's not priced into the markets.
Right.
So if this is a legitimate concern, I love Matt's personal asset allocation, then that's great because we could do this tomorrow. We could do this the next day, and we can still get the benefit of the kind of, I would say, protecting our portfolios a little bit against that risk. Because it hasn't all been priced in.
All right, before we get out of here, I want to talk about an ETF that's near and dear to my heart, and that would be the SMH. That would be the VanEck Semiconductor ETF. And it really feels like in the last year and a half or so, since this generative AI boom has really been first focused around those LLMs and OpenAI. There was really no way to express a view in that unless you were a VC or Microsoft. You know what I mean? And then it really came down very quickly to who was providing these high-end GPUs, right, to train these models. And obviously, NVIDIA just kind of stole the show. I have to think in 2002, NVIDIA was mid to low single digits % of the SMH. It was, I think, a $200 billion market cap company or something like that. Now it's 2.2 trillion. Okay, we can all do the math on that. It's 20% of this ETF. And it really has become like a verb, Uber or Google or something like that when we think about the semiconductor space. So Jan, first things first, how do you feel about that? You guys created this ETF that no one else has been able to come close to and it's been around for, I think, almost 15 years or so. And it's a great trading vehicle, but it's often, and to go back to what you just said, it's an amazing way to express an investment view in a secular shift, and you don't have to be all in on the one that's up 2,000%. You get a lot of great exposure. And then you also get the potential for some of these other names that are maybe 3-4% to do the same thing that an NVIDIA did maybe in the next leg of this secular theme. So talk to me a little bit about that and how investors who are listening should think about this, because again, I think at 20%, it's not unruly. You know what I mean? It could come in a bit and consolidate at some point at a much lower level, but it could have some other names pick up the slack a little bit. So how should investors be thinking about this ETF? Because it's one that a guy and I talk about every day on our pods and almost every day on CNBC also.
Yeah, I mean, listen, let me talk about the great things about it, and then I'll talk about the business angle, which may surprise you. So on the investment angle, it's the number one. I think it's the number one performing ETF in the industry over the last 10 years. Mm-hmm. It is, as semiconductors have gone from 2% of the S&P to 10% of the S&P. It is the purest, probably, expression of artificial intelligence trend, and it's got visibility. It's got only 25 stocks, and the beauty of that is they are the real winners. They're the survivors. 10 or 20 years ago, if you looked at a semiconductor company, they followed the product cycle. There was boom bust because of inventory, overbuild, and then catch up and all that kind of stuff. These companies now are much more sustainable because in their earnings and in their revenue. And also they beat their competitors. It's only 25 companies, but a lot of those companies have competitive moats. And that's according to Morningstar research, which we follow. So 12 have the highest rating of competitive advantage, and nine have the next highest. Mm-hmm. And you're talking about like this is only a small section of all stocks that have that competitive advantage. So that's all the beautiful stuff. Maybe it's a little bit overvalued, but I do think these trends continue. I talked to a macro AI person yesterday, consults to OpenAI and some of these other huge firms. I mean, the amount of capital that is going into this is just insane. Mm-hmm. You know, he thought that the $1 trillion number from NVIDIA was low by a factor. Okay, so that's that. Mm-hmm. On the business, the business takeaway is, you know, sometimes you get lucky. Yeah. So that ETF, or was it Origin? It was a trust product from Merrill called the holders. Mm-hmm. And they didn't earn any fees on the holders. They were just baskets of stocks that they couldn't change. And during the financial crisis, they were throwing assets over the window to try to get some money, so they sold them to us. We bought the 6 holders because of oil services. Mm-hmm. We wanted to complete our commodity suite, but we got semiconductors and regional banks and pharma and some of these other things. And we didn't really even design it. We just copied the design that was there. So a little bit.
That's a little old school. By the way, now that you say that, I remember that's what the H is. It's the holders, yes. And the BBH and the OIH. And by the way, we often use, OIH is synonymous with like oil service. There's no way you talk about it in our field in the same way. So listen, Kaitlin and I really enjoyed this conversation. We got to kind of peel back the onion a little bit. I think a lot of folks take ETFs for granted. And I, like I said, I started this conversation by saying that I remember the QQQ when it was 4 Qs, okay? And it was really one of the very few ETFs that were liquid enough to be actively traded. The same with the SPY, the DIA, that sort of thing. But like sector ETFs and some of these thematic ones, and now with HODL and the spot Bitcoin ETFs, it's just giving the everyday investor a lot more ways to kind of diversify and express views in the market. And so to me, like that's what we're here to do, to kind of help listeners, viewers kind of understand the way these work. And for you guys to come on and help us think about that is really great. So we really appreciate you being here. We hope you'll come back. Maybe there's an ETF coming up. What are you going to call that one? We'll figure it out. Maybe we'll workshop it on the tape. So Thank you guys very much. We really appreciate it.
Thank you guys.
Thanks.